Learning outcomes. After studying this module, you shall be able to understand the meaning and the types of government debt instruments. Understand the advantages of GSEC investments and the major investors of government securities. Analyze the yield and the pricing of government debt securities. Describe the process of issuance and the forms of holding of government securities. Let's introduce the subject. The debt market in India contains largely two categories: the government securities, which are otherwise also known as GSEC markets, comprising central governments and the state government securities, and the other segment is known as corporate debt market. Government has to fund the fiscal deficit through public borrowing. For that purpose, Reserve Bank of India, on behalf of Government of India, floats the fixed instruments in the market which are subscribed by various institutional and non-institutional investors. These instruments are known as sovereign securities and they are default-free securities for investors. They imply debt obligation on the part of the Government of India. Because of their default-free characteristic, they are also known as gilt-edged securities. Another category of the fixed income instruments include corporate bond, financial institutions bonds, and PSU bonds. They are not considered as default-free instruments and have to be rated by one or the other SEBI authorized rating agencies like CRISIL or ICRA. The rating assigned to them is an outcome of the credit risk of these securities. The central government and the state government fixed income securities are tradable instruments. They include short-term and long-term debt instruments issued by Reserve Bank of India on behalf of Government of India. Short-term instruments include treasury bills of maturity of 91 days, 183 days, and 364 days. While long-term instruments, also known as dated securities, include 5-year and 10-year maturity government bonds. State governments in India issue only long-term bonds, which are known as dated securities. They are also called state development loans. In India, banks have to mandatorily invest in fixed percentage of their deposits in designated government securities, which is called statutory liquidity ratio, abbreviated as SLR. These central and state government debt securities are eligible securities for fulfilling the SLR requirements by the banks. Hence, they are also known as SLR securities. While the debt instruments other than the government debt are not eligible for fulfilling the SLR requirements by the banks, hence they are also called non-SLR securities. Other T-bills and long-term bonds, Government of India also issues saving instruments known as NSCs, National Savings Certificates, and Kisan Vikas Patra, and special securities like oil bonds, fertilizer bonds, etc. These securities mobilize the small savings of households and are not tradable in the market. They are also not qualified as SLR securities. Therefore, government securities dominate the Indian debt market in terms of trade value and volume, market capitalization, etc. It sets a benchmark for the rest of the market. Types of government securities. There are different types of government securities, under which the major category is known as treasury bills. Treasury bills or T-bills are short-term debt instruments issued by the Government of India with less than 1 year of maturity. They are money market instruments issued by RBI on behalf of Government of India. RBI issues T-bills with 91 days, 182 days, and 364 days maturities through the process of auction. Auction to the issue, the T-bill is conducted by RBI every Wednesday. Payment for the T-bills purchase takes place on the following Friday. The auction of 91-day T-bills takes every Wednesday, while the auction of the treasury bills for 182 days and 364 days tenure is conducted on alternate Wednesdays. Treasury bills are zero coupon bond instruments and do not pay any interest during the tenure of the bond. T-bills are issued at a discount in comparison to the face value. At the maturity, they are redeemed at par. The differential between the two therefore accounts for the interest. For example, if a 91-day treasury bill of rupees 1000 par value is issued at rupees 990.30, meaning thereby at a discount of 9.70, it would be redeemed at the face value of rupees 1000. Now the difference between the two of rupees 9.70 will be treated as the discount or the interest for the holder of the instrument. Now, there are cash management bills issued by the Government of India. These are issued by RBI on behalf of Government of India and are issued with the purpose of filling the temporary shortfalls in the cash flow of the government. The CMBs or cash management bills is a short-term instrument having a similar characteristics as that of the T-bills, but their maturity is less than 91 days. Similar to the T-bills, the CMBs are also issued at a discount with reference to their face value and redeemed at par on the maturity. The term, size of the issue and the date of the issue of the CMBs are contingent upon the temporary cash flow requirement of the government. They are tradable instruments issued by Government of India and are classified as SLR securities. CMBs for the first time were issued in the month of May of 2010. Now, there are instruments known as dated government securities. They are long-term government securities known in the market as dated securities. Normally, they have a tenure of 5 years or 10 years. The government dated securities are issued by RBI through the process of, again, an auction. The pronouncement of the auction is made by RBI quite well in advance and also advertised in most of the newspapers. The government bonds normally carry fixed coupon rate which is payable periodically. However, they may also offer floating coupon rate which changes with the period of time. Coupon is calculated on the face value of the bond and normally are paid quarterly, semi-annually or maybe annually. For all the government debt securities, the registry or the depository function is performed by the office of the RBI known as Public Debt Office. They ensure the timely allotment of the bonds, payment of periodic coupon and the redemption of the bond. The terminology of the dated security coupon government debt instruments comprises largely the coupon rate, the issuer of the debt, maturity date and face value. For example, 7.49% GS 2017 implies that the coupon rate on this bond is 7.49%, which is paid on the face value of the bond. And the name of the issuer is Government of India. The date of the issuance, as is being mentioned clearly, is 2007, 16th April 2007, and the maturity is after 10 years, that is 16th April 2017. The coupon payment dates are half yearly, and the minimum size of the issue is rupees 10,000. When the two government securities with the similar characteristics have their maturity in the same year, then for the purpose of distinction, we have to mention clearly the maturity period. In one of the instruments, the month of maturity is added to the terminology of this security. For example, 6.05% GS 2019 FAB implies that the government debt security which has a coupon of 6.05% is going to have a maturity of February 2019. In case the coupon payment date falls on the holiday, then the coupon is paid on the next working day. On the other hand, if the redemption of the government bond falls due on the holiday, then the redemption payment will be made just on the previous working day. Let's talk about the types of dated securities. There are fixed rate bonds and there are floating rate bonds. Now, fixed rate bonds, as the name itself signifies, are the bonds which offer the investor a fixed rate of coupon to be paid on the face value. The coupon rate will remain fixed through the tenure of the bond, irrespective of any movement in the market interest rates. The majority of the government bonds carry fixed coupon rate. For example, on 22nd of April 2008, 8.25% GS 2018 was issued for a tenor of 10 years with a maturity date of April 22, 2018. Coupon payment frequency on this debt security is half yearly at 4.12%, which is half of the annual coupon of 8.24%. The coupon is calculated on the face value and paid on 22nd of October and 22nd of April of each year. Now let's talk about the floating rate bonds. These are the bonds which carry a coupon which is expressed as a base rate plus spread. It's not a fixed rate, but it's a floating rate. This base rate is set periodically where the reset period may be 3 months or 6 months. This base rate may be weighted average cutoff yield of last 364 days treasury bills or some other base rate as is decided by RBI from time to time. For example, on 2nd of July 2002, a floating rate bond was issued with a maturity date of 2nd July 2017 and the tenure was of 15 years. The weighted average rate of the last 364 days T-bill issue was kept as a base rate for these floating rate bonds, which was equal to 6.5%. A spread of 34 basis points was added to this base rate. Therefore, the final coupon rate was 6.84, that is 6.5% plus 34 basis points for the next 6 months. Zero coupon bonds. The zero coupon bonds are those bonds which don't offer any coupon to its investors. They are issued at discount to their face value and they are redeemed at maturity at their face value. The difference between the issue price and the redemption value, therefore, serves as the interest rate for investors. Since a long time, zero coupon bonds hasn't been issued by Government of India somehow. Now there are another kind of bonds which are inflation adjusted bonds known in the market as capital index bonds. These bonds aim at protecting the investor's capital from inflation. For this purpose, the principal of the bond is linked to some inflation index. In December 1997, a capital index bond was issued by Government of India in which the principal amount was hedged against the inflation. These bonds matured in year 2002. A fresh issuance of the inflation index bonds is being talked about and planned by the Government of India, wherein the payment of both the coupon as well as the principal on the bond will be linked to the inflation in the economy. For these bonds, the principal will be indexed against the inflation. The coupon will be calculated on the index principal. This will take care of the inflation for the investor in these bonds. Now there are bonds which can be issued with call and put options. Bonds which are issued by government with an option to buy back the bond by the Government of India prior to the maturity in case the general interest rate happens to go down a specified level. Thus, in case of bonds with the call option, the government has to right to buy back the bond at the face value. Similarly, the bonds with the put option are the bonds which give the investor the right to sell back the bond to the government at the face value prior to the maturity in a situation when the interest rates happen to rise about a specified level. For example, on 18th of July 2002, 6.72% GS 2012 were issued with a tenure of 10 years. The option on the bond could be exercised by any investor after completion of the 5 years tenure from the date of issuance. The option could be exercised on any coupon date falling thereafter. The option was available to the government as well as the investors. The government could take call option and the investors could take put option. The government has the right to exercise the call option to buy back the bond at par value, while the investor has the right to exercise the put option to sell the bond back to the government at par value at the time of any of the half-yearly coupon dates starting from July 18, 2017. The special securities are those securities which are issued by Government of India in place of cash subsidies. Some of the times the Government of India issues special debt securities to the PSUs like oil marketing companies, fertilizer companies, Food Corporation of India, etc. They are long-dated securities with a spread of about 20 to 25 basis points over the government-dated securities of a comparable maturity. There is another term called strips. The strips implies separate trading of registered interest and principal of securities. They are the instruments in which the principal amount and each coupon of a fixed coupon security is detached and is traded separately at zero coupon bond. Strips in government securities are being planned in Government of India. Such securities will ensure availability of the zero coupon government bonds, which will enable the contribution of market-linked zero coupon yield curve, known in this world as ZCYC. Strips will also serve as an additional instrument for the institutional investors to meet their asset liability management. Now let's talk about state development loans, SDLs. The dated securities issued by state government are known as SDL. SDLs are issued by the process of auction and they are eligible SLR securities and can be used under repo transaction as collateral. GSEC investments. Now let's talk about what are the major advantages of investing in these government securities. The government securities obviously carry no risk of default. They offer highest safety and least volatility. The benefits include instrument can be modified like index-linked bonds, strips, etc. Higher leverage value will be provided if funds are borrowed against these GSECs. No TDS is deducted on the interest earned on these bonds. On the interest earned on the government securities, the tax exemption is available up to a level of 3,000 rupees in addition to a limit of 12,000 rupees under Section 80L. The greater diversification opportunities are available in these government securities. Trading volume in the government securities is very high and therefore liquidity is very impressive. Now, who invests in these government securities? The major investors of government securities in India. Let's talk about them. The biggest of the investors of government securities in India are the commercial banks and the primary dealers. Banks also need to fulfill the SLR requirement and they therefore account for more than 60% of the trading volume in the government securities market in India. Other than commercial banks, all major institutional investors like mutual funds, insurance companies, NBFCs, foreign institutional investors and the corporate, they also happen to invest in the government market, which is called GSEC market, because of the safety and liquidity offered by these government securities. Let's talk about government securities yield and the pricing. Who decides the price of these bonds? Basically, it is the demand and supply which decides the prices. But the prices of these government securities are also dictated by some of the other factors, which are economic conditions, expected rate of inflation, money supply conditions in the economy, and the growth prospects of the economy, prevailing interest rates in the market, and the rate of new issues. The future interest rate forecasts based on the trade-off between growth and inflation, credit quality of the issuer, developments in the other markets like money market, foreign exchange market, credit and capital markets, they all happen to have an impact on the pricing of these bonds. Even the international bond market scenario, specifically the US Treasuries, that affect the pricing of the government securities in India too. Policy announcements by RBI, which include the changes in the key policy rates like repo rate, CRR, open market operations in the monetary policy, they also have to have an impact on the prices of government securities prevailing at any point of time. Now, a term which is very commonly discussed in this market is known as yield. What do you mean by the term called yield? Yield is basically an effective rate of interest earned by a bond investor. There are several yield concepts like current yield, yield to maturity known as YTM, which can be explained like this. YTM is the most popular measure of yield in the debt markets, and it represents the return on investments earned by the investor if they hold the security until maturity. YTM depends upon the market price, coupon rate, and the remaining term to maturity. Now, the current yield. At any point of time, the bond prevailing price will decide the yield being earned by the investor on that bond. The current yield is calculated by dividing the coupon by the market price. Very simply, current yield is equal to coupon divided by the market price multiplied by the face value of the bond. For example, if the market price of a 10.18% government security 2012 is rupees 120, the current yield on that bond will be 0.1018 divided by 120 into 100, giving us the current yield of 8.48%. Calculation of yield to maturity. YTM of a bond implies the return to the bondholder if the bond is held until maturity, given the price at which the bond is purchased by the investor. In other words, the YTM is like internal rate of return generated by bond investment. It is the rate at which the present value of all future cash inflows related to the bond becomes equivalent to the cash outflow or the current price of the bond, where the future cash flows include periodic interest as well as principal amount. An important assumption here is that the YTM is the reinvestment of the periodic coupon interest over the life of the bond at the same rate. YTM is calculated by applying the trial and error method or hit or miss approach to find out the rate at which the cash outflows become equal to the sum of the present value of the cash inflows. These cash flows include periodic payment and the redemption of the bond at maturity. Say, for example, we have a GSEC of 8% Government of India loan of 2004 with only two cash flows remaining until maturity. That is, the maturity date is 30th of January 2004 and the interest payment dates are 30th of January and 30th of July. And it is trading presently at 115 rupees. For 1 unit, we will have the YTM calculated as follows. The settlement date will be 17th of March 2003 and the interest payments are made twice and will have a day count convention of 30 by 360. YTM calculated in this case will be 4.8626 and the same can be computed through the MS Excel through the yield formula mentioned hereunder. This is the kind of thing you have to input in the Excel sheet to get an output calculating the YTM. YTM herein will be calculated as 4.86258. It can be checked up by discounting the said cash flows, which include two periodic payments of rupees 8 each and the principal payment of 100 on the maturity date of the settlement. Now this YTM is a great indicator of whether you should be buying the bond or not. Relationship of the price and the yield. Let's talk about it. Are they correlated or not? Oh well, yes. There is an inverse relationship between the value of the bond or the bond price and the yield on the debt securities. So when the bond prices fall, the yield on the same goes up and vice versa. Basically, it is impacted by the change in the market rate of interest. Therefore, whenever the market interest rate goes up, the price of the existing bonds fall down. Because of the simple reason that these existing bonds are offering lower rate of interest, whereas the rates prevailing in the market have gone up. Therefore, these bonds will lose their value. On the other hand, a decline in the interest rates will equivalently lead to increase in the bond prices because the existing bonds carry high coupon in comparison to the lower coupon being offered by the new issued debt securities in the market. Therefore, existing bonds gain value and trade at a higher price in comparison to their face value. These fluctuations ensure that the value of the bond will never remain same throughout the life of the bond because the prices will be either going up or going down. Now the process of issuance of the government securities in India. Let's talk about it. What is the mechanics of issuance of these government securities? These government securities are issued by the process of auction. An auction may be either yield-based or price-based. Let's talk about yield-based auction. In case of yield-based auction, the bidders quote the yield. A cutoff yield is decided by the RBI, and the bidders quoting the yield below the cutoff yield are allotted the securities, because that gives government the borrowing at a lower cost. Now, price-based auction, on the other hand, is a situation when the Government of India reissues securities already issued by the government. In this case, the bidders quote the prices, and RBI decides the cutoff price, and bidders quoting the price above the cutoff price will be obviously allotted the securities. If the auction is uniform, price auction, then everyone is allotted the securities at the same price, whereas in case of multiple price auction, the bidders have to pay their respective price or the yield at which they have made the bid. Holding of the government securities, how are they kept in the custody? The government debt securities can be held by the investors either in the physical form or nowadays in the demat form, known as dematerialized form. However, RBI regulated entities have to necessarily hold them in the demat form, physical form of securities holding. The government securities may be held in the form of stock certificates. A stock certificate is registered in the books of PDO, that means Public Debt Office. The ownership of stock certificates cannot be transferred by way of endorsement and delivery. They are transferred by executing a transfer form of the ownership, and transfer details are recorded in the books in the PDO office. The transfer of a stock certificate is final and valid only when the same is registered in the books of the PDO. That's a case of physical transfer. Demat form of holding. The government securities can be held by the investors in the dematerialized form or demat form. This is the most convenient and the safest mode of holding any investment. This electronic mode of holding allows convenient and fast sale and transfer of government securities and hassle-free servicing. Investor need not worry for the safe custody of the securities. There are two ways in which the investor can maintain their holdings in the government securities in the demat form, which are like this. One is SGL account. The RBI offers a subsidiary general ledger known as SGL account facility to select entities who can maintain their securities in SGL accounts maintained with the PDI office of RBI. The other account is known as gilt accounts. The eligibility to open and maintain the SGL account with the RBI is restricted to few entities like commercial banks and primary dealers. Therefore, other investors are given the option of opening a gilt account with the bank or a primary dealer that is eligible to open a constituent subsidiary general ledger account known as CSGL with RBI. Under this arrangement, the bank or the primary dealer will act as a custodian of the gilt account holders. It would maintain the holdings of its constituents in the CSGL account with the RBI. Let's summarize the debt instrument module. Different types of debt instruments which are normally traded in the debt market can be categorized into the following categories based on the issuer of these securities. For the government debt securities, the regulator is Reserve Bank of India, whereas for the corporate debt market, the regulator is SEBI. The GSECs are issued by RBI through the auction process. RBI offers a non-competitive bidding process for the retail investors in the GSECs, through which non-competitive bids will be allowed up to 5% of the notified amount in the retail category. The government securities can be held in either physical or in the demat form. The prices of government securities is influenced by the forces of demand and supply, general economic conditions, interest rates, inflation, money supply in the economy, and the developments in the international debt market as well as the currency market.